Hi everyone, welcome back to Be Rich. This is me, Vinod, recording remotely from Bangalore. Tomorrow I'm off to Singapore, so I wanted to get this one recorded. So as you're watching this video, I'm already in Singapore, and hopefully I'll get to meet some of you there in the week which I'm there. If you are interested in catching up with me, I have a WhatsApp number which I've shared on Instagram, and you guys can WhatsApp me, and I'll try and coordinate and catch up with as many of you can on Sunday. I'm initially planning on probably meeting on Sunday morning uh, around breakfast time. So nothing serious, just a meet and greet to say hello, how are you, find out how your tiffin coffee journey is going, and maybe have a few conversations about value where we find them, be it international markets like what we're talking about in Beerich, or Indian markets like what we're discussing on Instagram. But don't worry, if you are not available there, we're not going to have anything secret discuss. No secret patas list or anything. So don't have any FOMO that you're missing out something earth shattering other than meeting and having a cup of coffee. Today I wanted to talk about what had interestingly happened with tariffs and Walmart. Walmart had announced recently that thanks to the tariffs, there was going to be a price rise on their products on the shelves in the stores, and to apologize, saying there's nothing much they could do about it. And thanks to the tariffs and the lack of clarity on the tariffs, they don't have any choice but to pass these costs on. They try to minimize the cost on essential products and groceries and staples, while most of it being passed on into non essential products like electronics. Trump, of course, came out and said that company is making way too much money anyways, and looking at their profit margins, they can definitely eat the tariffs and not necessarily pass it on. Of course, then Walmart came back and rebutted and said, we are doing our best, and there's nothing really much we can do about this other than this. So, does Trump's tariff have a direct inflationary impact? That is up for debate. Something Walmart is saying it's a victim and a bellwether at the same time. Walmart's always considered a company to see as a bellwether for inflation in the US, especially consumer inflation. And this again highlights the problem of the tariffs. Walmart is a company which has diverse sourcing. It's just not dependent on China. Even with diverse sourcing, the way the tariffs are structured, it's not helping Walmart. The consumer confidence in the US has been falling, especially amongst the middle class and the lower middle class. And the Wall Streets might have rallied, but the main streets and the broader economy seems to be hurting and is showing signs of stress. So where does this leave Walmart? We're not here to talk about macroeconomics. We're here to see if Walmart is a company we should be considering at this current price. Walmart is a very old company, and I don't really need to dive into what Walmart is and the history of Walmart. What we're more concerned about is where is Walmart priced right now, and what is the future of Walmart, considering the current environment the US is in. Walmart is priced right now at $98 a share, and with discounted cash flow, looking at it through discounted cash flow, I'll come around to a price of $45 and a relative value of 71, placing the intrinsic value close to $60. But if you see the price of Walmart over the history of the last 5 years, from June 2020 to June 2023, it was at a very good price and it was actually at a bargain. Walmart was trading anywhere between $37 to $50 during this period of 3 years, believe it or not. From 2023 to 2025, from $50, it has rallied to around $102 at and $104 at its peak, then dropped thanks to the tariff announcements to $81 before Wall Street pushing it back to $98. So this is the price swing Walmart has gone through. It was, of course, without question, a tremendous value during 2020 to 2023. So those of you who did manage to consider Walmart during those times must be feeling pretty happy with yourselves looking at your portfolio right now. So the question remains, should we be looking at Walmart right now? Let's say you've never bought Walmart and you saw the rally Walmart has gone through. Should you be buying Walmart? Well, the revenue of quarter one is standing at $165 billion, which is up 2.5% year on year. And the EPS right now is at $0.61, which is pretty much where the analysts said it would be. Sales have been up in the US by 4.5%, while globally it's been up by 22% thanks to the major e-commerce push and the digital push Walmart's been doing. Operation income is up by 3% per year on year at $73.3 billion. Financially speaking, Walmart has been very consistent in the last 10 years in terms of growth, and the free cash flow stands at $15.1 billion, which is up from the $12 billion just about a year ago. The debt to equity ratio shows at 0.67 which means the debt in Walmart is very low and it's very manageable because if you see their interest coverage, it's very, very strong. So, what are the red flags? Because I've said everything what I've said is so tremendously good about Walmart. And if everything is great, so then what are the red flags? The main red flags is one, tariffs. There is a lot of uncertainty in the tariffs. First, when the tariffs went to, then where it's come down to, and the way the tariffs are being looked at, each individual country being negotiated one-on-one with the American government does not seem a feasible way to go about it. It's going to take way too long to get these agreements done. And so Trump is even hinting at that he'll just send out letters saying to each country, this is a tariff which we're going to be at, and you give us this, take it or leave it. So we really don't know how this is going to roll out. Of course, China being the main player seems to have come to some kind of an agreement, but do realize it is all they've come to an agreement is from the 145% tariff, they've lowered it down to the current levels where it is at. It is not the tariffs have gone away completely. I'm speaking, there's a broad 10% tariff across everything in the US right now. This is all very evident if you see the customs receipt in the US. It has shot up in the last few months compared to what it was. This shows that a significant at the border customs are being charged and is being received by the American government. Of course, that may be good for the American government, but it's not great news for the businesses trying to do business in the US. And all this cost is being directly passed on to consumers. And that is very apparent if you see the data and the noise which is coming out from the US. In US, lending has been growing in non-banking financials. It's gone up by $1.2 trillion. That is US bank lending to buyout firms and private credit groups, which is fueling a steep rise in loans, which is almost up 20% year on year, which is starting to worry regulators. At the same time, companies like Klarna, which lends money to consumers in the US, buy now and pay later system, has seen losses widening, and the fintech losses have more than doubled in the first quarter. This, of course, means more defaults, and these defaults are sparking fear in the US consumer. Is it really resilient, or is it going to be struggling going forward with all these tariffs? Meanwhile, the Chinese, who are holding a lot of USD bills for the first time since the year 2000, have dipped in their holdings below the UK. All this time since the 2000s, so for the last 25 years, the Chinese have had a larger holding of American Treasuries, the T-bills, than even the United Kingdom. They've been slowly moving it and selling it and reallocating it in such a way that they've gone below the UK, which shows there's a strategy, there's a change in the policies of the central banks in China and wider countries. Meanwhile, if you see the hiring for America's students and the fresh graduates, there has also been a freeze for the age group between 22 to 27. There's been a rise of unemployment to 6% in the month of March. So factoring all this in, where does this leave us with Walmart, right? The PE ratio is at 41.9, right? The forward is at 36. The PEG is at 4.77, which is suggesting it's already at a premium looking at the growth. Price to book is at 9.3. Of course, investor confidence is very high. The price is already reflecting that. The dividend yield is at 0.91. So do you think Walmart is a great buy? Where I've just painted the picture of the American economy in the main street, where it is, where the credit is, where the pain is, where the tariffs are. What do you think? Do you think Walmart is a great buy at this position? Would you say this is a temporary blip? This will get through, and after that, year on year, we're going to see these? Or do you think the future earnings of Walmart have already been factored into the price, and the price is reflecting that? Is it too expensive now? Would you rather wait and watch and wait for another opportunity like we saw between 2000 to 2023 when Walmart was very cheap? This is what I wanted to know. Of course, I wanted to think about this while we're talking about its competitor Target. Target is priced right now at $97. So is Target a better buy than Walmart? So tomorrow I'll try and talk about Target, comparing this to Walmart, and make a proposition: should you be looking at Target instead of Walmart? If you're on the camp Target, please put down in the comments below why you think Target should be looked at rather than Walmart. If you're on Walmart and you think Target is not a great buy and why Walmart still should be in your consideration, I would love to hear your comments below on why you think Walmart is. Thanks for watching the video as always. It's been great having you today evening with me on Be Rich. Wishing you nothing more than the best. Take care and see you tomorrow. Good night.